Today we're going to talk about understanding the weekly cycle and how Monday and Tuesday can be a big part of that. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Big week in some of the pairs. We had some pretty much fantastic moves almost every single day this week. I know that some traders have really started to get their groove, stepping back, looking at some of the simple concepts that I go over each and every day with my own trading, just keeping it simple. We're going to review our basic steps to the market, but we're also going to talk about the importance of Monday and Tuesday and how that can help us establish a thesis as the week evolves for some potentially bigger trades happening later in the week or from the high or the low of the week. We'll look at some trend trades, we'll look at some reversal trades, and we'll look at some range bound trades. Coming back to first part, we're going to review some of the initial balances for the week and then how that information could be extrapolated out over the next few days, how each and every day as it unfolds, as we talked about in the last video about the timings of the 24-hour cycles, the basic sort of template throughout the clock. So we're going to go into Monday and Tuesday and understanding how that initial balance can help us really determine a bias each day or potentially develop a bias each day and help to identify the best setups. So one of the questions that I've been getting a lot is if I could only pick one pair or a couple of pairs, which would they be? And that's where the understanding the importance of Monday and Tuesday comes in, because it doesn't matter to me what instrument it is. And as I've explained, I mainly follow the British pound crosses because typically they have movements of at least 50 pips in either both sessions or at least one that is usually a textbook type of setup. Now it doesn't mean that I'm hitting all those trades, but ideally I know that when the clock rotates around to that 12 candle window that I will be looking for the best setup on one or two of those pairs, but I'm constantly monitoring other instruments as well as the other pairs to see how, as the session unfolds, they trade and how they move around the numbers and the highs and lows of the day. We're going to talk about median price again and just looking at each day as the day unfolds in the Asian range and how those number levels can help us identify the median price and where our 50 pip box may be and where we can ideally look for a potential trade to set up from in terms of locking in the lows for a move back up or vice versa off the highs or a breakout pullback continuation for a trend trade. We're going to talk about measured moves. I had a couple of comments regarding measured moves. Some traders felt that me using my measuring tool is cherry picking in hindsight. So there's some concepts that traders need to understand about measured moves if they don't already know this. So I've said this before, if you haven't done so, get Richard Schabacker's book, Technical Analysis and Stock Market Profits. I've put the link below. This book was originally printed in the second edition, first printed in 1932. So if you don't understand measured moves and you think it's cherry picking, go back and read Edwards and McGee or Schabacker's book on basic geometrical patterns for measured move targets. Peter Brandt's two books. Peter bases most of his approach on classical charting methods. Measured moves are not cherry picking trades in hindsight. They are helping you to identify possible expansions of ranges of trades that you're already in. So instead of just going, oh, I want to get 20 pips or 40 pips or 50 pips, whatever that may be, when you've got a high and a low and the market breaks through a level for a continuation, you're targeting expansions of that range as a potential target based on the geometry of the structure that's set up that it broke out of. So the longer a market has possibly traded in that range, the higher the probability once it breaks out to expand that it will do a geometrical expansion of 100%, 200%, and in strong markets maybe 300 or 400%. This comes back to our original topic today in understanding the weekly cycle. So those measured moves are important because that's what helps us identify the possibly bigger trade setups as the week evolves. So when we just come back to our basic approach to the market, we'll talk about median price and that 24-hour cycle in a second, but just looking at Monday and Tuesday. As Monday unfolds, we could be trading and the market may move within a certain range. As it heads into Tuesday, we now have a low of the week and we have a high of the week. That's the geometry that I'm working from, because as this market starts to trade on Tuesday, we may find that it trades inside of that range, or it may expand out of that range 2 days. And I've said this in many videos, in a high percentage of the case, Monday or Tuesday will often be the high or the low of the week. Now that can also mean the extreme. So it may not end up being the high or the low, but it may end up being a level that the market works up into. So we go back to the high of Monday, which was the high of the week, and our low of the week. And I've talked about day 1, day 2. Well, if on day 2 we're still inside, but on day 3 we're up top, then I look at this as 1 push, 2 pushes, and this market may come back on Thursday, and people are saying, well, that's day 3, level 3. But we may also get a retest now back up for the 3rd push to the high of the week, and on Friday get our Friday reversal. And that new low of the week will that Friday reversal may fail at the swing low of our redrawn low of the week. Yes, I know that the low of the week is down here, but as this market has moved higher up and Friday's rolled over or reversed possibly, the redrawn low from Thursday, Wednesday, Thursday may be where that market fails as we head into the week. But coming back to understanding the weekly cycle, we're going to look at some examples this week of all different scenarios, but the importance of how Monday, Tuesday will often end up being the extremes that the market trades back and forth from. Or if the market has done a Monday, Tuesday range expansion, we may have already met our AWR, our average weekly range. And then the market may trade and work one side for a move back, or it may trade inside of that weekly high and low. Or we may find a Monday, Tuesday that works up high and they work it a 3rd time, as we saw in some of the pound crosses, for a big move down on the Wednesday or Thursday, only to see it come back and retest that high because they've traded to the low of the week and now they're going back to the other side. That's a really important concept to understand. So when people ask which pair could you follow if you only had to choose one, as I mentioned before, thinking that one pair is going to be the best pair to trade will often get you caught in traps, trying to trade one market every day the same. All markets will go through these same patterns and cycles: equities, commodities, futures, currencies. It doesn't matter. They all go through the same behaviors. But what I do like to look for is day 0. Day 0 to me is a very tight consolidated day, 50, maybe less than 75 pips. That will often possibly come at the end of a week or the beginning of a week if we're going to see a possible reversal. And that compression and decrease in volatility is often where the market will be building up either for a reversal or a continuation, but we'll get a bit of a range expansion maybe on day 1, and day 2 can often be the day that we get this big trend day where they don't come back. And that's, again, we're going to look at some examples of those types of setups. But Monday and Tuesday can help us identify a very strong thesis, especially as the week unfolds, if we're not already in those trades. So again, median price. Just to go back and talk about our 50 pip boxes. We saw some great examples again, and we'll go through some examples on the videos, on the charts today. If the market is trading inside of a 50 pip box, there's a high probability that that middle quarter level is our median price. If the market is trading around the double zeros or the 50 level, there's a high probability that not only is that currently the median price, but one of these quarter levels above or below may be an area where they're trapping volume. And that's really important to tune into, because if they're trading down off of the double zeros or off the 50 and they're swinging in this 25 and the market's going 25 and 25, don't be surprised if they eventually shift this up, maybe in the end of the US session or in New York. But that tells you a lot about the next day as well, because they've got all this trap volume. This market may be now moving to take off for 50 or 100 pips off of that trap volume. The same thing applies if they're moving it down, and the same thing applies if we're inside, where we have a high of the day and a low of the day. We can expect a trade potentially off of the bottom, or if the market is jamming in, potentially off the numbers or off the top. So again, there's squeezes and then there's the high and the low trade. But that median price, no matter where you're at, it's important to know not to be trading the swings inside of that unless it's after they've jammed them in and that pin hammer shows up on the numbers for the move up or down from that level. And again, we'll look at some examples. Measured moves, so we talked about that, using structure not only for the session itself, but for the Monday, Tuesday, if the market was to break out, especially if we have a day zero, okay, compression or a smaller volatility day, an inside day, a narrow range day, that's when we can start to look for that possible, the market may have come down, we get a smaller volatility type day, could be a couple of days. They trade Monday, Tuesday, Friday, Monday, but then the market squeezes for a big move, and we may even see a second day trade follow that, as we did on the Euro Yen last week. So then we talked about the timings last day. So when we tie in our weekly cycle, our Monday, Tuesday, high of the week, low of the week setups, with our timing cycle over the 24 hours that we reviewed yesterday, the 12 candle window, the 717, the stop hunt hour, and the 915, the 4 hour, the 1 hour, the 15 minute, and the 1 minute time frames all rolling over at once. Okay, then understanding 25 to 50 pips. So if median price, let's say median price is 25, okay? Median price is 25. Well, we know that we can expect a potential stop hunt 25 to 50 pips from that median price. And that's where our timings come into play, because when London opens, if they're at median price and they're working down and they're at the end of that 12 candle window, they've just spent 3 hours to go down 25 pips. That most likely now is forming a low of the day setup. Now again, that just as an example, that may be our low of the week. We may be working down and jamming in for a W squeeze for a move up with the bigger up trend, or vice versa if it's a down move. I'm just using the example of 25 to 50 pips. If the market breaks down and pulls back and we're into the open of London and it keeps going, you might be looking for something down at that 50 pips from the Asian range at the round numbers, specifically if it's a double zero or a 50. If you're at a quarter level, again, the timings are critical, because if we're in that gap time, we may not be down. There's still may be another 25 pip move down, because we know that that market, the critical time frame is when that 12 candle window starts. If they haven't broken through that level, or if they've come up and they're working back up into the trend, then the upper quarter level may be significant for a measured move or a stop hunt to the low of the day, depending on where we're at in that timing cycle. So 25 to 50 pips, especially on the US majors, that's really powerful, because 25 pips is typically usually the furthest those will move, unless we're at the low of a week or the high of a week and they're squeezing it up on day 3 for a move back in the other direction, or if we've had a breakout of a compression pattern on a day 0, day 1 for a trend trade going back out of that geometrical range. So we'll look at some examples of Monday, Tuesday, median price, as well as some measured moves in the timings. My suggestion for you for your homework over the weekend is to go back through your own pairs and be able to walk through this process from the beginning of the day and recognize the numbers and how the high and low can help you identify the median price, and then extrapolate your 25 to 50 pip targets. If the market runs away before you get to the Europe London Open, you can start to again have a thesis. Well, we've moved away. Maybe it's now making me chase the trade. The technical indicators will be indicating that it's a trend trade. Remember, and we can probably go through almost every single day this week on most of those pairs. Almost every single day they end up hitting the high and the low before that day is finished. So very important. And go through your own charts, mark those levels off, be able to walk through and working backwards how you're going to see it in live time. There's the high, there's the low, there's my median price. They're working down into the open of Europe, or working up into the open of Europe to the high or to the low or to the numbers. Okay, well, they break out. I'm expecting a pullback into the numbers. They've broken out of that 25 pip box. It's a breakout pullback, or they're working the high or working the low as we head into the end of that 12 candle window, or they've already done the stop hunt and it's a second tap for the move at the open of London. Just those types of scenarios. Be able to recognize that in live time using the clock, that hourly cycle, the 15-minute rotations. Are we up high? Are we down low? And then be able to again deconstruct it so that you can see it in live time. So again, thank you for all the comments and questions. Hopefully these examples today on the video will help understand the importance of as the week evolves, of the high and the low, and as that range expands, how your risk reward targets can increase, and again, when you're up high or down low, when to recognize when that market may be getting ready to reverse, or if it's a pullback for a continuation in a strong move. Again, thanks for all the positive feedback. Thank you for hitting the like button. A ton of great emails, again, some traders, just the improvements, just the little improvements. And I just will close on this note. I recently was reviewing some stuff that was sent to me by another trader, and how he's been targeting a certain percentage each day, and how when you focus on just sticking to your best setups, how some traders are hitting 5 and 6 and 7% a day, just by playing it safe and conservative and being patient and not getting greedy, not engaging in self-sabotaging behaviors or impulsive, irrational, erratic behavior, but sticking to some simple timing concepts, the numbers, the highs and the lows, engulfments and pin hammers, how they have changed their trading from losing to being profitable in a span of 6 weeks, to now actually projecting out that certain targets can be hit. And that's how fast things can change. You have to be able to work on those things yourself, and also have that edge and be willing to stick to that edge and know what your edge is. You know, add those nuances that will help you improve your results. Keep getting better. Don't be impatient. This is a scalable market. When you start to identify the best setups, and instead of just chasing moves and getting impatient and frustrated, stepping back and being prepared to put a bit of size on when you get that consistency in your results, and then being amazed that when you take that trade, how fast it moves to its target, or how consistently steady it moves to the target without you having any stress. That's when you understand the importance of identifying the best setups, because those are the trades that never go against you. And those are the trades that usually go right through their target, whether it's in 4 bars or 12 bars, but they very rarely ever work against you. And when you can lock in 50 pips even 2-3 times a week with very little stress, and you're not taking piker trades and poor quality setups and chasing these other little moves that are draining your energy, giving you 50-50 results and getting you frustrated and impatient, step back, become a sniper, focus on the best setups and learn how to trade them better, and then gradually bump up size. So hope you have a great weekend. Stay disciplined, stay focused. Do your homework, keep it simple. Let's look at some chart examples from the week. We're going to look at the majors as well. Keep getting better, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading, continuing our discussion on the initial balance, the importance of Monday, Tuesday in the weekly cycle, and using that to help us identify potentially sell high setups or buy low setups at the high of the week, low of the week, and also trend trades. And all, just if we use this information, or how I use this information, comes back to just some simple concepts, understanding that the market is going to establish or be trading inside of a larger geometrical range. And also, we have a high of the week, a low of the week scenario. Well, those are hard, concrete facts. So when traders talk about hindsight trading or anything else, that's all fine. But I'm talking about taking something to the market each day that's already been market-generated information that we can use to our advantage to, number one, hopefully keep us out of poor quality setups and getting caught on the inside, and also identifying the highest probability pairs potentially for trading on the day, and also the best setups potentially out of those pairs. So when we look at the British pound from Monday, the pink line again is our Monday. Forget about timings and everything else for now. We're just looking at our previous sessions highs and lows before the week even starts. So we have Friday's US session high and low projected into Monday's range. And Monday trades, and we'll talk about median price while we're here. But our Monday high low does not get to the extremes, but we do again go down to the low. The market stays underneath of the breakout level quarter, which was the 75 level on the Monday. So when we look at the Asian session, we talked about median price briefly. Now this is an example of where the Asian session is trading inside of a quarter level, and we're on top of round numbers. Now, normally the best setups will come off of round numbers or trap volume in a quarter level above or below. When we see the market trading inside of the quarter level, and the Europe and London candles are inside of that quarter level, we now know we want to be working from the lows and the highs, because this market is trading inside. The median price in this particular case is the middle of this 25 pip box. So we want to be selling at the high or buying at the low. Now in this particular example, the sell high setup came at the end of the 12 candle window off of the quarter level with a pin hammer inside of the swing high from Friday. The thesis would be that this market would now head back down to the low of the previous week. It did not. It went 1, 2, 3 and reversed off of the lower quarter level, where now we can see that our median price in this particular case, as we head into the US session 12 candle window, the median price for the day now, as it's expanded out, becomes the 50 level. So our Monday initial opening balance is an inside day. It's inside of Friday's low high, but also our median price as we head into the US session is the middle of that 50 pip box. So again, as the day started, we were inside of a 25 pip box. When Europe and London opened, we are still inside. So we have the high of the day and the low of the day as our areas looking for trade setups, whether it's a breakout pullback for a trend trade, or if it's a sell high, buy low scenario. This ended up being a sell high setup, went down 50 pips, and a 1, 2, 3 bar engulfment off the quarter level. Some traders did take this. We talked about this earlier last week, but at the beginning of the 12 candle window, we have we'll blow this up. We have the pin hammer closing above the median price. The high and the low now are at the quarter levels. The median price is at 50. There's our 50 pip box for a 50 pip move back towards the double zeros to the high of the day. Now again, as our Tuesday unfolds, so again, this is information that the market generates. This is not hindsight trading. We're talking about the high and the low of the week and the previous session. We're still inside, but now we're thinking the market went down, but it came back through the high of the day. It's come back 25 pips, gone into consolidation, and then broke back up above the quarter level. So again, Europe opens, London's down low, our median price in our 50 pip box becomes the quarter level at 75. So again, we are using our same scenario of buy low, sell high setups. We have a 1, 2, 3 pin hammer, and then a open drive candle that closes at the quarter level. So again, I'm not identifying these as trades. I'm just going through how this market and median price. Initially, we had trapped volume. You'll notice the volume is up above the 75 level. And then what do? They go to the low of the day because they have long volume trapped up above. They hit the stops before coming back. And you need to be thinking, where are the other stops? The previous day's high as well as Friday's U.S. session high. They break above. They head into the U.S. session 12 candle window, and they've gone 1, 2, 3 in the 7 o'clock hour, the stop hunt hour, 7 o'clock New York time. Pin hammer off of the quarter level, so we've had a 50 pip move from the median price through the previous day's high, breakout pullback, and then in the first hour, traders chase the move long into the numbers after the pin hammer. So again, if we were to look at this now as if we were to redraw our highs and lows, okay, we have a high, we have a low, our median price is the double zeros. The market breaks down, pulls back, stop hunting traders that have sold high before breaking back down through the low of the day. So median price, you can extrapolate, every time the market moves and restarts for the next session, we do our high and our low. Where's the middle of our 25 or our 50 pip box? Are we in a 25 pip box? Are we in a 50 pip box? Where is the trap volume? Well, clearly anything that was chasing the move after the stop hunt to the high of the day, once this market shifts, is now trapped. We get a stop hunt back into the peak formation. Traders may have taken this pin hammer long, chasing the move, but then the second candle, which is the last candle of the equities hour, now confirms once that market drops down that this is trap volume as well. But coming back to our original topic, Monday, Tuesday now gives us our initial balance potentially for the high of the week and the low of the week. And obviously we have Friday's low still there just below. But our opening range of Monday, Tuesday, there's our high and our low of our week. So then the question becomes, as we get to Wednesday, are they working the high? Are they working the low? Well, clearly we have a 1 push, 2 push, 3 pushes down into the low of the week. Okay, this is typical level 3 behavior, right? 3 pushes, 33 setup. This is where traders get confused. We have day 1, day 2, they've taken it higher, but now we have level 1, level 2, and then a 1, 2, 3 on level 3. So we have 1 push, 2 pushes, and then 1, 2, 3 for our level 3 trade and the reversal of the lowest rectangle. So again, heading into the next session, we are above as Asia unfolds. So again, we're coming to the screen later. So this information is already made available to us. The market breaks up into the upper quarter above the Wednesday's range. And again, look at the screen. Start to see this. Everything underneath of this 25 pip box is trap volume. When they move above and pull back and shift off the double zeros heading into the Europe Open, all of this volume is trapped. So think about what they want to do. They want to put heat into all these traders that are still holding on. And that market breaks back up to the quarter level, comes back down 1, 2, 3 into the London Open before shifting above the previous day's high. So again, we could classify this potentially as a day zero. So day zero is when we get a tight, narrow range, and the market could be compressing for a reversal or continuation. The market gets 3 pushes in a sideways rectangle. So we talked about measured moves. Okay, so there's a geometrical structure we can put a measured move on, which is not quite 50 pips, but give or take it's probably 50 from high to low. The market on Thursday breaks out, pulls back, and continues up towards the high of the week. Now, it gets up towards that upper quarter level before failing and coming back. But again, this is where I emphasize the importance of timings. If you're holding on to this, and here we are, 6 hours later, and that market breaks to a new high, you definitely want to be following this up, because as we head towards the end of the 12 candle window and they're underneath the numbers without taking out the high or hitting that measured move, that may be that. So mathematically, this may be the measured move, but if we were to tighten that up off of numbers or off bodies, you can see that move is 50 pips already. So point being is that as the timings become more important, as you head in towards the end of that 12 candle window, that move is most likely coming to the end of its exhaustion, especially when you get the 1, 2, 3 inside of a high pin, that market's ready to come back. So again, just to emphasize, Monday, Tuesday, we're still inside of that range from Monday, Tuesday. And again, as we head towards Friday's session, we've come out of a low, so there's level 1, possibly level 2 yesterday. The market's made a new high, hitting the high of the week, and possibly we may see another 1, 2, 3 setup or a breakout pullback trend day on Monday. Point being, though, we stayed in that high-low from Monday, Tuesday for the entire week, so we want to be targeting areas at the low of the week and the high of the week. So traders who are shorting this, and it's not going anywhere, this is your first clue for the next day, especially when we see that pullback and then give us a peak formation on top of that breakout. Our bias for the next day has got to be long. Okay, we're looking at the euro yen. The reason why I'm looking at the euro yen is this is a great example of a day 0, day 1 compression type trade for a measured move. When we look at Monday, we have Friday's high and low similar to the pound. We had Friday's U.S. session low and U.S. session high when the week begins. And then Monday, as the session starts to trade, again, you can see we're trading inside of a 50 pip box, and we have a quarter level that is our median price. So again, the timings are critical, because as Europe opens, we break down below the median price and stop hunt back up into it with our little bar. And you'll notice the market, London high low, we work back up into the median price, and 1 push, 2 push, 3 pushes into the open of the U.S. session for a move back down through the low of the week. So the median price, this is our 50 pip box. The market broke down below the median price and worked back up into it for a move back down through not only the 50 level, but the low of the week. tight range, very narrow range day. So again, there's our first clue. A lot of these will happen on a Friday or a Monday, and you can identify, in a lot of cases, reversal type setups. So we're now in that lower quarter as we head into the next day on Tuesday. And again, Monday, Tuesday, high percentage of time will be the low or the high of the week. The market goes sideways before pulling back above the 50 level in Asia, up towards our median price from the day before. So now we have a smaller geometrical structure. That was a small rectangle off the low that the market has broken out of. So again, savvy traders will understand that this potentially now is in a reversal situation. We had the narrow range day. Monday's low has pulled back inside of Friday's U.S. session lows inside of this 50 pip box, stop hunted up towards the median price, and then gone down 1, 2, 3 to the bottom of the 2450 level before pulling back and then moving quickly above not only the Europe high, the Europe open high, but the median price from Monday. So again, a couple traders said that you can't use that measuring tool. That mean you're doing that in hindsight, that you think that's where you're saying that's where the market is going to go before you really see it in live time. And what I'm telling you is that if you understand classical charting and measured movements, you'll understand that when you take a trade, that instead of just holding on for whenever it ends, that you can now put a target in place for where these levels could become significant based on the geometrical structure that it breaks out of, and also the bias of that movement headed in that direction. So we see that that smaller 50 pip rectangle breaks out, pulls back, gives us our peak formation stop hunt low into the London Open for a continuation move back through the high of that box before pushing 1 push, 2 push, 3 pushes down. And that second push down gives us our middle structure now to target for stops on a follow through. The market moves up 50 pips before coming back 50 pips into the close of the session. But again, when we go into our Asian session, the market stays on top of the 00 level. Also, the high of the US session, and on top of that bigger geometrical box. This is an ideal textbook setup for a squeeze trade. We have our ascending triangle formed in the Asian session. Our obvious target is the previous day's high, because we know there are short traders in the market in that sell-off. The market has come down 1 push, 2 push, 3 pushes before pulling back at the 00s, working sideways, giving us our type 3W for the breakout pullback continuation for a very strong trending day. And again, this is an example of a squeeze trend trade where they do not come back, and traders are looking for the stop hunt later in the session. And there is no stop hunt because these trades do not come back. And you'll notice again heading into the next day, this is a trade that I did take. The second day trade after a strong move, this is something that I will look for, a market that again exhibits the similar characteristics of the first day of the trend trade, where it stays in a very tight compression around the round numbers. 25 pips usually on the second day is as far as it will come back. That market pulls back, goes into consolidation on top of the pullback breakout from the night before. Again, going sideways on top of the numbers and squeezing before moving and breaking out in the direction of the previous day's high. That's a dead giveaway. So there was 2 entries for me. One was at numbers. The second one was on the pin hammer at the beginning of the 3rd hour for the follow through of that 50 pip move. There was a similar setup on the pound yen. The pound yen for a similar trade. But what I liked about the euro yen was the fact that we had such a strong move on the day before, and then when we got the consolidation, this is exactly what I was looking for. but that market went up to the high. So again, coming back to our original geometry, this is the sort of trade setups that I look for as the highest probability setups for big explosive trend trades. When we get a tight geometrical range, we had the previous high of the week was still above our geometry. We've broken out, pulled back 25 pips up to the median price before stop hunting down into the peak formation, which was a 3-push pattern reversal. Big trend day, a pullback and a squeeze. So we have day 1, day 2, and then the final day, day 3, and we get, as my good friend Malik said, 33 trades everywhere. 1 push, 2 push, 3 pushes. Okay, so understanding the timings, understanding the ADR, understanding that there's been a 50 pip trade on a third day with a 33 blow off into the US session 12 candle window, and then a 1-2 sideways 3 engulfment underneath of the numbers, underneath of the quarter level. So again, if we talked about high and low, we have a 25 pip box and a 25 pip box, which means our median price is 50. So again, we want to be selling high or buying low in that 50 pip box, unless the market gives us a squeeze setup, which we will show an example of. But 33 trade on the Wednesday at the high of the week, which, coming back to our box again, if we look at our measuring tool, we've already exceeded 2 full expansions of that range, which is typically my target. But as this market set up, again, try to learn how to squeeze the most out of a winning trade as possible. If you are in a winner and you can try and squeeze more out of that, more than 25 or 50 pips, maybe get 75, whatever that may be, that will bring your positive expectancy ratio higher. And as we head into Friday, we can see again the market pulled back in Asia underneath stop hunting traders who shorted the 33, and also hitting stops on the last traders who shorted that last swing into the close. So we have a high and a low. The market works its way up, hits the high and drops down, goes sideways on the quarter level. So again, if we were to just use our common sense, we're in a 50 pip box. Our median price then is 25. We have stops below the trap volume from the previous day. So again, this cluster of volume that's long, if they haven't taken anything off, if this market does come down, we know that there's stops. So again, the point of understanding this consolidation is that if the market does break down and pulls back as it did, that it potentially may still follow through to that second quarter level because there's trap volume that's caught that it has not yet stopped out. But when we look at our chart and we just stick to basic price action, as we head into the Europe London 12 candle window, we have our 25 pip box. We have volume sitting on top of that. So 2 scenarios. One is it pulls away and goes up, or 2, it drops down, putting heat into the volume that's already trapped, hitting stops from that session. We're underneath of the 33 peak formation from the night before at the high of the week. We've worked back up into it. We're in a rectangular high and low. The market moves sideways at the quarter level before dropping down, hitting stops, pulling back, hitting the stops on the trap volume from Thursday's long trade. So again, these traders are in the money. What are they going to do? They're going to go back and get the money before pulling back and going into consolidation inside of the previous day's low. So looking at the pound New Zealand, again, our Monday, we have our Friday. The market is inside of Thursday's high when we open on Monday and Friday's low. Now again, if we look for narrow range days, we see a 50 pip box. That was payrolls. The market broke out of. We had a tight range. So again, I would look at that as a day zero type setup. The market broke out on after the payrolls in the U.S. session. We're inside of Thursday's peak formation. Monday opens up on top of the quarter level, works its way up to the double zeros, pushes down, pushes down, pushes down, 3 pushes. So 3 hours, almost 5 hours later, it's only moved 25 pips to the low of the day. We already have a breakout in progress from Friday's session. We have a high of the day and a low of the day. The market breaks through the high of the day at the Europe Open, continuing that move before putting a high in place 25 pips above the Asian range. So again, we talked about 25 to 50 pips. So initially traders have taken this thinking it would go right through to the previous Thursday's high. Drops down 25 pips before coming back a second time, giving us a 1, 2, 3 pin hammer engulfment for the move back down into traders that are long. Fails to follow through, and we get a 1 push, 2 push, 3 pushes for the 50 pip move to Thursday's high. So Monday's session has now given us a high of the week and a low of the week. We come into the next day. Immediately in Asia, they drop it down 50 pips, pull it back into the double zeros before dropping it another 50, taking out not only the London lows, but the lows of that Asian session as well. So I'll just draw this across. But at the numbers, at the bottom of that 50 pip box, it pulls back inside at the Europe Open, working up 25 pips back up to the round to the double zeros before 25 pips stop hunt back down into traders that are long. So again, we talked about middle structure. More importantly, no, we have a low of the week now, and we have a high of the week. We had our initial range expansion that was 2 full expansions of Friday's 50 pip box. If we get rid of this for a second, we now have a Monday, Tuesday high and low. The market comes back and hits the high, 1 push, comes back into the U.S. session, 1 push back, 2 pushes back, 3 pushes to the high before pulling back. So again, we've now extended the high of the week, and our high of the week is in place as we come into Wednesday's session. We had news on Wednesday for the New Zealand rate announcement. Market has worked the high, worked the high, worked the high, pulled back, but then gone up again the next day. We talked about how they sold it off heading into the news for the stop hunt to the high. So again, asking yourself, are they working the high or working the low? We have a high and a low in place from Monday's high and Tuesday's low. The market extends out towards the high of the announcement candle before dropping back and moving back towards the low of the week without hitting that full expansion. But again, the timings are, so if you're holding on for that second full expansion, there's again 2 scenarios. We could put this onto that 50 pip box and target that range. We can target 100 pips above that 50 pip box. But if you're not there yet, wherever your target may be, at the end of that 12 candle window and you get an engulfment, you need to close that trade out and take the money. So again, the numbers were 100 pips up. We're into that 3rd hour, and the market's only moved another 25. So we had our Asia range that moved it up 25 and another 25 to 50 pips before reversing and stop hunting back down on traders who were long from Tuesday's session. As we head into Thursday, again, we talked about this, the rollover. The market immediately came back up, hitting the high rectangle after 3 pushes into the low. So again, 1 push, 2 push, 3 pushes into the peak formation. So we're stop hunting into the peak formation. They break out, pull back. We put a peak formation in Asia down. The peak formation is down before breaking out. So it doesn't always have to be at the very low of the week. It can be inside of a range. So they've had a peak formation put in place. They've hit it 2 more times. They've shifted the market, breakout, pullback, continuation. This is a double distribution day. If you're not familiar with what that is, look it up on Market Profile. They break out, pull back, break out again into the open of the Europe 12 candle window, pull it back, layer on top, and extend the move out for a measured move of another 50 pips, taking out the high of the week. So again, the high of the week keeps getting higher. So they're working the high. And you'll notice they didn't go through the low of the week. They went down into stops for the low of the week, but they're making new highs. Making new highs. We head into Friday's session, and immediately in Asia, they break out 1, 2, 3 to the high, triggering breakout orders, hitting stops, profit taking, whatever that may be, and then come back 1, 2, 3. Hit the stops on the peak formation one more time. Get traders shorting this market, thinking that that's the high for the week, for the reversal, before 1 push, 2 push, and reversal. So we have 1 push, 2 push, 3 pushes. Double tap on the low with our middle structure. Timing, so first hour is a trap stop hunt, taking traders into the down into the move, stop hunt into the traders that are long, but getting traders to chase that move before reversing and engulfing, giving us our W formation for a type 2 W, engulfment, doji, pin hammer for the 50 pip move back up to the high of the week. So we were making new highs, pulling back 25 to 50 pips, consolidation, shifting, median price. Again, we're in a 50 pip box. So Asia splits the box. We're below here, and then we break above. Our median price then is the quarter level. So part of Asia is below, part of it's above. We're in a 50 pip box. The middle price is 75. They hit it. They hit it a second time. The market shifts with an engulfment above the median price. Pin hammer, 50 pips. Back through the high of the day. Breakout pullback. 3 pushes into the trend. Pin hammer engulfment for the 50 pip move back to the high. So Monday, Tuesday can help us identify our bias for selling high, buying low, stop hunts to the high, stop hunts to the low, median price, higher highs, lower highs, whatever that may be, depending on the bias of the market. But keep it simple. Step back, look at the big picture, pay attention to the timings, take money off the table when you're in profit and you get to the latter parts of that 3-hour, 12 candle window and it hasn't hit your target. Pay attention to the little things. Keep getting better, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburktrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.